It's my particular pleasure today to welcome you to listen to our guest, Senator Byron L. Dorgan of North Dakota. He was first elected to the U.S. Senate in 1992, and where he served on a number of significant committees, including the Democratic Policy Committee, of which he's the chairman. He's also an author of several best-selling books, including Take This Job and Ship It, How Corporate Greed and Brain-Dead Politics Are Selling Out America, and a newly released book, Reckless, How Debt, Deregulation, and Dark Money Nearly Bankrupted America and How We Can Fix It. I like that phrase, dark money, in particular. But it's the latter subject, in the words of his title, How Debt, Deregulation, and Dark Money Nearly Bankrupted America, that brings us together today. Back in 1994, in the Washington Monthly, Senator Dorgan wrote an article, Just What Are Derivatives and How Dangerous Are They? This was 15 years ago. And he explained that these contracts might directly or indirectly cause some localized or particularized trouble in the financial markets to spread uncontrollably. He pointed out that at the time, the derivatives accounted for $35 trillion. This was back in 1994, a multiple of the $16 trillion U.S. GDP of the time. And 15 years ago, Senator Dorgan proposed regulation that held that if an institution has deposits insured by the federal government, it should not be involved in trading risky derivatives. The classic purpose of deposit insurance, one of the enduring legacies of the New Deal, is to encourage saving and create a pool of capital to build homes and businesses and jobs. Now, bear in mind, this is 15 years ago. My proposal would not affect traditional conservative forms of hedging, and banks, so long as they created pools of betting money outside their federally insured deposits, could gamble to their heart's content, but not with our money. Well, as the saying goes, a prophet is not without honor, save in his own country and his own house, and we hope to prove that that is not the case, at least in the New America Foundation. And before we listen to Senator Dorgan, both about what led to this crisis and of even more urgent concern, what can be done to get us out of it, I'd like to invite Paul Glastris, the editor of the Washington Monthly, which originally published this very insightful and far-seeing article to explain something about both the magazine and Senator Dorgan's contribution to it in 1994. Paul?
Thank you, Michael. Thank you all for coming, and thanks to folks watching on our webcast. And I want to thank Senator Dorgan for many years, a great help to the magazine, a contributor, somebody who we think of as a kind of ideal public servant. He knows Washington backward and forward, knows how to use it for good, and knows how horrible things can be here and the trouble that Washington can cause. We're celebrating our 40th anniversary this year, and our 40th anniversary issue is out soon. And in putting that together, we had occasion to reread some of the stories that we've published over the years, where we foresaw the destruction of the space shuttle, where we foresaw the collapse of the real estate market and the destruction of the economy back in 2004. And it occurred to me that one of the things that we don't do well in Washington is look around the corner, is see where things are leading. We tend the processes here to deal with the crisis du jour, and it's a rare public servant, a rare journalist that will focus their attention on what could be. You don't get much of an audience for it. When Senator Dorgan published his piece in 1994, and I wasn't the editor then, that was Charlie Peters, it got some notice. It wasn't as if the earth stood still. You put out a good piece of work and you try to publicize it, but the truth is that Washington often doesn't want to hear the problems of the future. And so when we find a public servant who's capable of focusing the attention of his staff, focusing the attention of the city on what will be, I think we should honor it. And so we're just I just want to say how proud I am of Senator Dorgan and his work, and hope that he'll continue to write for us, because profits are rare indeed. So thank you all for coming, and Senator Dorgan, we look forward to hearing what you have to say about the future.
Well, thank you very much, Paul, and thanks to the New America Foundation and to the Washington Monthly. I must tell you that before I came to Washington, D.C. to serve in the House of Representatives first and then in the Senate, back in North Dakota, I used to read the Washington Monthly, and I would read Charlie Peters tilting at windmills, and it is, I think, a wonderful, wonderful publication that gets... it probably doesn't have the largest circulation, but the circulation it has is, in my judgment, very, very important, and it contributes something very important to this town and to public policy. I've written two what I consider significant articles for the Washington Monthly. First was on the farm program, a rather lengthy article on the farm program some long while ago, and then I wrote about the economy and especially about derivatives. And I was looking at this today. It was 15 years ago. It seems like a moment ago, but the title is that I wrote about was Very Risky Business, of course off of a Tom Cruise movie title, Risky Business, but very risky business. And quote, if we don't watch out, a new kind of Wall Street gambling and exotic derivatives trading could shake the market and put the taxpayers in line for another bailout. Little did we know how large that bailout was going to be. We're somewhere around 11 to 12 trillion dollars and counting, the amount of money on behalf of the American taxpayer that has been extended and put at risk in order to try to prevent the imminent or the collapse of the entire economy last fall. And by the way, let me just mention to you, in the book that I wrote, Reckless, I have a little piece in that book about Spam. You know, that's low-cost luncheon meat produced by Hormel. And the reason I wrote about Spam was I was sitting in a room like this with many senators, and we had the Treasury Secretary leaning over the lectern like this, saying to us in ominous tones, if you don't pass a 3-page bill giving me $700 billion in 3 days, this entire world economy could collapse. And he described the knowledge that he had based on all kinds of economic indices and economic indicators. And as he was describing his sophisticated economic indicators, I was thinking to myself of something I had read, which was really, to me, a pretty important indicator, and that was that Hormel Meats had just put on a third shift in their Spam plant. Now, Spam, as you know, is a low-cost luncheon meat. And I'm thinking to myself, what better indicator of economic stress than going to a third shift in low-cost luncheon meat? And then I'm thinking, I wonder if the Treasury Secretary, having made $65 million the year previous, has ever eaten luncheon meat, Spam especially. Well, so anyway, I wrote about that just because there are a lot of ways to evaluate what's happening in the economy. For me, Spam was one of them. Let me say, first of all, that when I wrote this piece in 1994, the derivatives market was $35 trillion around the world, roughly, about $16 trillion here in the U.S. And what prompted me to write something about it was FDIC-insured banks were trading derivatives on their own proprietary accounts. Now, that's different, right? I mean, it's different to trade on your own proprietary accounts because then you put your capital at risk, and your capital, and by the way, your deposits are insured by the taxpayer. And I was furious that we had FDIC-insured banks essentially just gambling. I pointed out, why not just put a Keno table in their lobby? Same thing. Or I said in the piece, if you want to gamble, go to Las Vegas. But don't do it with FDIC-insured deposits. That is fundamentally wrong and unbelievably risky. But the derivatives issue is one part of, I think, what has become an avalanche of greed over a long period of time, and an understanding that business, quote unquote, is not what it used to be. It's something much different. And so I want to talk just a little bit about a number of things that converge that put us in the position of great peril. The financial wreckage that occurred, especially late September, October, That financial wreckage was building for a long, long while, and it resulted in a very large bailout of Wall Street. And that bailout of $700 billion called TARP funds, which was itself a bait-and-switch program, was said to be necessary in order to avert a complete crash. But to look in the rearview mirror just for a moment, and I think it's important to do that, we had a subprime loan scandal which sort of traveled by itself but then connected in several parts to the financial system. The subprime loan scandal should not have surprised any of us. I mean, all of us would have the television set on when you're brushing your teeth in the morning, or the radio perhaps, and you would see the advertisements for what was out there. And here, let me just read a couple of them. This is Countrywide, the largest mortgage broker in this country, largest mortgage bank. Quote, and this is their advertisement: do you have perfect credit? Do you have late mortgage payments? Have you been denied by other lenders? Call us. We've got money. Millennium Mortgage, quote, 12 months, no mortgage payment? That's right. We'll give you the money to make your first 12 months payments if you call in the next 7 days. We pay it for you. Our loan program may reduce your current monthly payments by 50% and allow no payments for the first 12 months. Or Zoom Credit. Credit approval is just seconds away. Get on the fast track at Zoom Credit. At the speed of light, Zoom Credit will pre-approve you for a loan, car, home, and so on. Even if your credit's in the tank, Zoom Credit's like money in the bank. We specialize in credit repair, debt consolidation, bankruptcy, slow credit, no credit. Who cares? That's the advertisement. Now, just ask yourself, this is what's on the air, advertising on behalf of financial institutions, and we watched it. I mean, it's very much like this morning I heard that I should be asking my doctor whether I need a purple pill or whether I need Flomax. I mean, this unbelievable advertising. Now, I know better than that. We should have known better than that with respect to these mortgage advertisements. Now, what was the result of all of this? Well, Countrywide, Millennia, and others were putting out paper. In fact, they were putting out home mortgages in which you name your own payment. They put out mortgages in which you don't have to document your income. They're called liar's loans. They were putting out mortgages in which you don't have to make the first 12 months payments. In fact, if you didn't like the structure, they'd said, no principal at all, just pay interest. Can't do that? Well, then, no principal, and you don't have to pay all the interest. We'll put it all on the back side of the mortgage. And by the way, you don't have to describe your income to us in order to get the mortgage. And so what happens is you put out paper like that, and by the way, people were getting cold calls at home, in a home they owned with a mortgage they had, that said to them, you know what, here's a 2% interest rate loan. Now, maybe they should have known better, but how many of you read your loan documents when you got a home mortgage? Now, and so they said, here's the 2%, a teaser rate, and it gets you in, and then it resets in 3 years. But it doesn't matter. Even if you can't repay that reset, what happens is the home prices are going up, and you just flip it and make a lot of money. I mean, that's the way. And so that was the proposition that was going on around this country. Meanwhile, what was happening to the financial institutions, Countrywide and others, they were packaging these loans up, some good loans, some bad loans, packaging them up, then securitizing them, selling them forward, which meant they could sell the risk. And you don't have to underwrite. Underwriting means, in my hometown of 300 people, the banker sat down with somebody that was going to borrow some money and said, okay, give me a notion of your collateral. Let me find out whether you're a good risk. Can you repay this? If you can repay it, then we want to give you a loan. That's called underwriting. You sit across the desk and make a judgment. Is this a good loan? You don't have to underwrite if you sell the risk. In other words, securitize it, sell the loan up, sell it up 2-3 times. Sell it up to a hedge fund, to an investment bank, and then it gets traded even more. And at some point when they try to foreclose, somebody in Florida had a great idea for those who are being foreclosed upon. Go to court during the proceeding and say, show me the original mortgage. The fact is they couldn't find them. Isn't that something? I mean, that tells you also a lot about the business practice. But they were all making massive amounts of money. The brokers, the mortgage banks, the hedge funds, everybody was making lots of money, and nobody was talking about what's the foundation for this. Is the foundation solid? Are we doing something that is risky for the country and for our institution? It raises the question of securitization. This mad rush to securitize everything, should that continue? Was that smart? Is it a good thing? Also, it raised questions about rating agencies. How is it that rating agencies that are paid by those that they rate have decided to rate as AAA things that were fundamentally bad? The issue of the regulators, especially the Commodity Futures Trading Commission, that was so busy sending out no action letters so they didn't have to look. They said, you know what, we're willing to be willfully blind. You can get involved in derivatives trading and put it outside there. It can become dark money that we don't have to watch as regulators. We had regulators come to town in recent years that willfully boasted that they wanted to be blind as regulators. And then with respect to hedge funds and investment banks, you all know, I mean, we know very little about what they have been doing. Hedge funds, in most cases, you don't know what kind of risk or exposure that exists there. I've been suggesting for a long while that we should be regulating both hedge funds and derivatives trading. But the Congress has not seen fit to do that yet. So all of this was going on, all of it. I mean, it's unbelievable just in the context of what we learn in business school about what good business is. And it happened because an avalanche of greed, number one, and number two, regulators who were supposed to be regulating that decided they didn't want to. In fact, they boasted about not being willing to regulate. And so there we are. Now, Alan Greenspan, one of the culprits here who didn't regulate and should have and had responsibilities, wrote a book following all this, suggesting that, or implying that he was exploring the surface of Mars while all this was taking place. He wasn't. He was chairman of the Federal Reserve Board and should have known much better. But it's not just Alan Greenspan. It is a range of others that have failed us. And so the question is, what do we do now? Well, the American people are plenty angry about this and should be. I came to work this morning, and on the car radio, I heard that last quarter had record home foreclosures in the United States. I also heard in the same radio broadcast that Wall Street was going to pay record bonuses this year, $140 billion. Now I'm thinking, if you're just a person out there someplace struggling to keep your job or struggling to find a job because you've lost your job or struggling to keep your home, think of listening to the news reports that says there's going to be $140 billion of bonuses on Wall Street, and we just had record home foreclosures. I mean, that's a puzzle without all the pieces, isn't it, for a country that wants to do well for everybody and lift everybody. So the question is, what do we do about all that? Well, in my judgment, we should have done two things but have not. And so we're now trying to play catch-up. Number one, we should have, beginning last fall, established a select committee of the Congress to do the master narrative. I'm talking about real hearings, aggressive hearings, many hearings with subpoena power to develop the master narrative of exactly what has happened, what really has happened. And then once you understand what has happened, make financial reform the first order of business, not the last order of business. Not sometime towards the end of the year. Financial reform is critical because you need to try to restore confidence in the American people that we have a financial system they can trust. How easy is it for the American people to trust a financial system in this country now when you expose the underbelly here of what we have now learned about what was going on Wall Street and elsewhere? That's why I think financial reform should have been early in this year, but it was not. 10 years ago, on the floor of the United States Senate, we were debating something called Gramm-Leach-Bliley. It didn't get a lot of publicity at the time, but it was a critically important piece of legislation. And it took apart the basic protections that were put in place after the Great Depression. I said on the floor of the United States Senate, I was just looking for the quote, but in 1999, Gramm-Leach-Bliley, 3 Republican legislators, but very strongly supported by the Clinton administration, by Mr. Rubin and Summers and others, they decided that in order for us to compete with the Europeans and others, we had to get rid of things like Glass-Steagall. And we had to allow the creation of large holding companies with firewalls, but large holding companies that allowed us to put back the combinations of banking and real estate and so on. And I felt it was unbelievably ignorant to do that. And on the floor of the Senate in 1999, I was one of 8 senators to vote against it. I gave 4 or 5 long speeches against it and said, quote, this bill will raise the likelihood of future massive taxpayer bailouts. Now, that's not because I'm so prescient. It's because we learned the lesson once. You don't have to learn the same lesson twice if you're smart. But in my judgment, that repeal and the creation of large holding companies and now leaving us in a circumstance where we have a very concentrated financial system put this country in great peril, especially in as much as at the same time, largely in the same period, regulators boasted about not being interested in regulating. Now, the issues that are the big questions now for us are the following. For me, securitization. What do we do about that? For the last 15 or 20 years, we've just moved headlong into this issue of securitizing everything. Is that smart? Should it continue? And we have to have a significant discussion about that. With securitization, you have to have some capability of understanding who's rating the securities and is the rating reasonable. How can anyone have confidence in the rating agencies? And second, if you continue to securitize, are you going to continue to allow the selling of risk forward, which means you don't have to underwrite at the bottom? And that makes no sense. So we have to address that, in my judgment. The issue of restoring protections. Do we continue with these very large holding companies? Do we decide firewalls made of tissue paper are firewalls that give us confidence? Not me. So what do you do about that? Should we regulate derivatives? I certainly think we should, and both the House and the Senate are talking about that in proposed legislation, but how extensive? And will the regulation be effective? What about hedge funds? How do we bring all that dark money out into the disinfectant of sunlight so that everybody can see what kind of systemic risks exist? What kinds of agencies should be involved in assessing systemic risk? The administration has said the Federal Reserve Board. I don't know. It seems to me if you were to look at what is the most secretive and least transparent organization in this town, it'd be the Federal Reserve Board. I'm not sure that's who I would choose. Well, I know I wouldn't choose the Fed to be the arbiter of what is a systemic risk. Investment banks. I mean, what do you do about investment banks? They are necessary, although someone once said that investment banks are to productive enterprise like mud wrestling is to the performing arts. I understand that much better, having, especially in the last 10 years, I understand that quote much better than I did. Let me just show you some news reports quickly about Wall Street, investment banks, and so on. This is July 2009. Steve Pearlstein. The dust hasn't settled on Wall Street, but history is repeating itself. The herd is at it again, even as the cleanup crew is carting away the debris left by the last financial crisis. Investment banks, hedge funds, and exchanges are busy working on the next one. Forget collateral CDOs and credit default swaps. The new thing is high-frequency trading. Wall Street wizardry reworks mortgages, October. Wall Street Journal. A new wave of financial alchemy is emerging on Wall Street as banks and insurers seek to make soured securities look better. The Wall Street casino back in business, September, Washington Post. The Wall Street's actual role is more like that of a giant casino where gamblers are rewarded for taking outrageous, unconscionable risk with other people's money. If the bet pays off, the gamblers win. If the long shot bets turn sour, we're the ones who lose. 1 year later, little change on Wall Street. This is the New York Times. After the collapse of Lehman Brothers, the surprise is how little has changed in the financial industry. Banks still sell and trade unregulated derivatives despite their role in the last fall's chaos and so on. I don't need to do more. I've got more. Financial meltdown crisis has not altered Wall Street. Bankers play dress up with old deals. Wall Street stealth lobby defends $35 billion derivative salt. The point I'm making to you is now, finally, at long last, and too long in my judgment, the House and Senate are turning to try to find out how do we create some sort of financial regulation that will prevent this from happening in the future. But enough time has elapsed so that I think the amount of muscle available to lobby against this legislation is going to make it very difficult to pass. Not impossible. I think we will pass financial reform. I think it will be weaker than if we had passed financial reform earlier in this year. Now, one of the significant issues for me is too big to fail. And my concern is that we cannot finish financial reform if we leave in place the doctrine of too big to fail. That bit of no-fault capitalism for the largest financial enterprises in the country is, in my judgment, unsustainable. Let me just quote for you Professor Joe Stiglitz. He says, "We know that these too big to fail banks have enormous resources to lobby Congress to deregulate it. We've seen it. Now we're suffering it as a consequence." And Stiglitz also says, "Being too big to fail creates perverse incentives for excessive risk-taking. The taxpayers bear the loss while bondholders, shareholders, and managers get the reward." Richard Fisher, president of the Dallas Fed, says, "Too big to fail is not a policy, it's a problem. Too big to fail means too big, period." And when we talk about financial reform, at the end of the day, the question of whether we have really done what we need to do for the American people and to protect this economy will revolve around the judgment of, have we resolved this issue of too big to fail? I want to just end with one other thing. I want you to think for a moment about how we grew up and what we felt about banks and what we knew about banks, FDIC insured banks and bankers. You know, the banker in my little hometown, 300 people. We didn't have banking competition. We had one bank, and he's a good guy. I mean, he wore a gray suit. He had wireless glasses without wire rims. You know, he had a pretty severe look, and when you went to that bank, you understood that he had other people's money, and if you needed some of it, you needed to borrow some of it, you're going to have to make a pretty good case that you're going to be able to pay it back. It's very simple banking, and that was at, you know, the lowest level of banking in small towns. And I sat next to a banker, about November last year, at the Wishick Sauerkraut Festival in Wishick, North Dakota. Small town banker, 1,200 people live in Wishick. I asked him, this is a time when there's chaos in the big banks, and you know, the big banks are shaky and so on. I said, "Do you have money to lend?" He said, "Oh yeah, I've got money." And I said, "Well, do you have any financial difficulty?" No. I didn't. He said, we don't buy all those derivatives and all those fancy mortgages." He said, "I just do banking the old-fashioned way. I take deposits in, and then I loan money out, and when I loan money, I sit across from the people I'm going to loan it to, and so it works real well." He said, "That's banking the old-fashioned way. It's the way banking always used to work." And then I asked myself the question, how is it that when the bank in Wishick, North Dakota is doing just fine, you know, he's taking in deposits, making loans, making some money, that Wachovia had $120 billion of bad assets. How is it that you end up running a bank called Wachovia with $120 billion in bad assets? Well, I think it's probably cultural rot of some sort. I mean, Wachovia, and I think Wachovia had purchased First Union and so on. One of the first times I talked about Wachovia on the floor of the Senate was to talk about how they had purchased German sewer systems so that they could depreciate German sewer systems and save a couple $100 million in U.S. taxes. And I said, you know, what would a bank know about a German sewer system? First of all, you can't take it because it only serves a German city, right? You can't possibly be a sewage specialist if you're a bank. And yet we understand they were buying sewer systems in German cities to lease back to the city so they could then depreciate a sewer system in a foreign country in order to avoid paying several $100 million of taxes to the U.S. government. That's cultural rot. So does it surprise you that a bank that is engaged in that ends up with $120 billion of bad assets because they went out and bought Golden West that was doing the pick-a-payment program for mortgages? What's your payment? Pick a payment. Does that surprise you that this whole thing went bottoms up? I mean, it's nuts. So, or WAMU and so, you know, Wells Fargo picks up Wachovia, and J.P. Morgan Chase picks up WAMU. Both of them had all these bad assets, and you ask, how could that have happened? Where were the folks that were supposed to regulate this? And so there are far more questions, I suppose, even than answers at this point, because we still don't have the entire master narrative of what has happened here, and that's regrettable. I wish we had. But now we are struggling to try to find a way through the Senate and the House to put together financial reform. We have the recommendations of the President, some pretty good recommendations, I think. Both of our committees, banking committees in the House and Senate, will now spend some months trying to put this piece together. And my hope is at the end of the day we will have some financial reform that gives us some confidence going forward that what has happened here in the last not only year, but the last 10 and 15 years can never happen again. Let me stop at that point, and let me just quote Ogden Nash as I stop, because there's a lot of finger pointing, a lot of people saying it wasn't us, it was them. It was a lot of people. Ogden Nash had a little 4-line poem about a guy and his wife who didn't get along. He drinks because he scolds. Excuse me. He drinks because she scolds, he thinks. She scolds because he drinks, she thinks. Neither will admit what's really true. He's a drunk and she's a shrew. And it seems to me that's an appropriate metaphor for all of those folks that are pointing fingers. He did it, she did it. The fact is we had a whole lot of folks made a lot of money that brought this economy down, and we need to set it right. Thank you very much.
Thank you, Senator Dorgan. I just want to raise one point of disagreement. You say a banker cannot be a sewage specialist. And I think we've seen you can not only be a sewage specialist, but a sewage manufacturer. I'm going to use the moderator's prerogative to ask the first question, which is this. There seem to be basically two approaches to reform. One involves regulating the post-1999 system, where you have these financial conglomerates and you have better regulation and more transparency and you realign incentives. The other more pessimistic approach says, and you find this debate in Britain and in other countries as well as here, you have to have what in Britain is called narrow banking, which used to have a different technical meaning, but now basically means retail banking. It means separating commercial banking, the classic kind of intermediation you spoke about in a small town bank, and completely separating that from the casino. And then you figure out what to do with the casino. But you force banks, so it's essentially a new Glass-Steagall, structural separation. My question is twofold. Do you agree with that characterization of the basic option? And what do you think the prospects are for a neo-Glass-Steagall, as it were?
Well, first of all, I do agree with that. I think that the two choices are, one, a much more aggressive regime of regulation. And, we have been treated now almost and conditioned to understand that regulation is a 4-letter word. It is not. Regulation is essential for an economy to function in a free market capitalistic system. The allocator of goods and services in this system of ours is fine, but you need a referee because sometimes people try to break it and decide to violate the rules of the system. We have a system that requires competition and so on, but you need a referee. It seems to me to call the fouls. And that's what we have not had. So we start with the notion that we've been conditioned to believe that regulation somehow is inappropriate or bad. It is not. Regulation is essential for the working of this economy. Now, I'm not suggesting over-regulation or smothering regulation. I'm suggesting effective regulation. I think there are two strategies going forward. One is to accept what was done a decade ago and say, all right, what was done a decade ago will not be changed. There are some who say you just can't turn back the clock a decade. I don't necessarily agree with that, but then you have to have much more aggressive regulation in order to make this work going forward, if it can work. The other is to say, no, we're going to have to go back and decide that we're going to separate FDIC-insured banking as a separate function, and we're going to treat that almost as a utility. I mean, it used to be that way. They're going to make money because they have a business plan that makes money by and large. You regulate that FDIC-insured portion, then you take the other portion over here. You describe it as casino, which it has been recently, but it needn't be that. It can be the function of investment banking and others that provides the capital that's necessary for an economy to grow. Unfortunately, what we have seen more recently, it provides capital for interest in those kinds of investment banks and other enterprises to simply reward themselves. And so I think those are the two choices. Move forward with the current structure with much, much more effective regulation and transparency, which is another key, or go back and begin a separation of the FDIC-insured banking enterprises and then move investment banks. By the way, we need investment banks, despite the quote I used. You need investment banks, but we need investment banks doing the right thing, and that is helping create the capital by which we expand and create jobs in this country.
We have questions. Danny has the microphone. Please identify yourself and ask a question.
I don't think. Dana Chasen, OMB Watch. Senator, why aren't you on the banking committee?
Because I'm on the Appropriations Committee, the Energy Committee, the Commerce Committee, and the Indian Affairs Committee.
Well, I was being facetious. I was hoping maybe there was a way you could find the time for yet another committee. Which aspect of financial regulatory reform will you be most focused and active on in the coming months?
Well, there are a lot of them. I think at the end I described one of my great concerns is that we need to, when we put a financial regulatory scheme together that we think can work, we need to have addressed the issue at the end of this process of too big to fail. The doctrine of too big to fail, in my judgment, is no-fault capitalism, and we need to find a way to address that. There are a number of ways of addressing it, but even those that are now considered too big to fail are getting bigger, and they're getting bigger as a result of an acceptance of that by the federal government. Well, I don't accept that. So there are a number of ways to get at it, but I think we have to, at the end of this, keep putting pressure on this doctrine of too big to fail.
Mark Gruenberg of Press Associates News Service. Two quick questions. Your second alternative, when you split out the retail bankers from the casino, what would you do then with the casino? That's the first one. The second one is, is there any way to just plain outlaw these pieces of paper that aren't based on anything, that aren't based on productive assets?
It's hard to outlaw something that is not productive. Our system allows people not to be productive and to develop things that aren't productive. Several products come to mind, but I think it's hard. I guess you're asking about when you develop credit default swaps, CDOs, derivatives, synthetic derivatives, and so on. And you have people engaged in financial engineering, which has only happened in the last couple of decades. The financial engineering of saying, let's create sophisticated, exotic products that only we understand, and in some cases that we won't understand, but will make us a lot of money. You're asking, I think, is there a way to shut all that down? Well, I think there is at least partially a way to do that. The commission or the agency that has been proposed by the president is an agency that would, very much like the Food and Drug Administration, I assume, be able to test some of these products. Are these products risky, dangerous? Do they have value? Or is this something somebody's created just to throw out there that could have substantial risk and have very little value at all, except for the purpose of furthering or expanding the casino? The agency that I think is to protect consumers, designed to protect consumers, when it is completed as a part of financial reform, I think probably will have the capability to address some of those issues. Oh, well, then you've got to, even in that circumstance, when you create the insured enterprises over here as a separate adjunct, essentially running them as a utility, or not, I shouldn't say regulated as a utility, which we had done before, and then you have this other enterprise over here that is non-insured, provided that you deal with the too big to fail, then they're perfectly capable, out with the restrictions that I just described about perhaps the creation of products that could be risky for people. They're perfectly able to go ahead and lose money if they want, or to decide to do dumb things at their own risk. But what has happened is we've had people take unbelievable risks, knowing that the taxpayer ultimately is going to bear the responsibility. But the short answer is you'd still have to have regulation for that, but substantially less regulation than those that are insured by the taxpayer.
Hi,
I'm sorry, go ahead.
I'm Mike Telsey, University of California. My question is, not only, you sketched out a beautiful description of how this system imperiled the whole economy. But it also seems to me it also imperiled bankers like your banker in Wishick, where basically the big banks were able to undercut, by lower rates, the bankers like you described. I hope these people are very active in trying to protect themselves as well as protecting the system. Have you found that to be the case?
Oh, yes. Oh, yeah.
Thanks.
Almost everybody engaged in this debate is very interested in protecting themselves. That's
I would be a little worried about putting the full weight on regulation if the system behind it did not have incentives to do the things that we would want our financial system to do for the economy. I see a disconnect, increasing disconnect with this originate to distribute between institutions that are going for more and more volume and more layers, and not, as you point out, value and character. And so I would ask you to think about that when you're thinking about how you organize what the incentive should be. If I don't keep the loan, I don't keep any of the credit risk, why should I not just push the money out? In the days of the bankers that you were describing, they held the loan, and their own compensation was tied to the continuing good portfolio they had.
That's very well said. I mean, it's underwriting, first of all, and then servicing the loan and having your compensation respond to how well you did in selecting the loans that you wanted to make. You say that very, very well, and I think that's an important element.
Hi, Senator. Fawn Johnson with Dow Jones Newswires. You outlined a couple of options going forward, but you didn't state a preference. So I'm wondering if you can tell us which of the two options you would like to see and what you're going to try and do to influence that process. And then if you could comment on the AIG bonuses as well, that would be helpful. Thanks.
Well, the masters, the what do they call them? The master, whatever he is Pazar is taking a look at those bonuses now. Apparently there's some legal issues, and significant legal issues, which raises the question of whether someone in the Treasury should have known that before they did what they did. But it's another subject. I think it is not just those loans. It's the loans. The bonuses. Not just those bonuses, but it's those bonuses and the 60 to 70 billion dollars in bonuses that are set to pay out very soon with three of the largest investment banks. All of that together, I think, is going to cause a crescendo of noise across this country, and should, in my judgment, because it is another reflection of something that's fundamentally wrong with this system. Kind of relates to what you just said. And as for my preference was that would be that 1999 hadn't happened, but it did. And as you know, it was, although I described it as Gramm-Leach-Bliley, three Republicans, it was fully bipartisan, fully supported by a Democratic administration, and had only 8 of us in the Senate vote against it. So there was and has been, and probably is even now, a very strong component of support for continuing holding companies and so on. My preference would be that we go back and revisit the issue of whether holding companies have any long-term protection for the American people, and whether that's the best way for us to do finance. It's interesting that the reason it was done was, we were told the reason that we had to modernize, quote unquote, was to compete with others outside of our country. Got to modernize. They're modernizing. We have to modernize. It seems to me it wasn't modernizing at all. It seems to me that it was turning backwards. Yes.
I'm Mike Olshausen. In all the turmoil and financial injury which has been experienced by Americans and others abroad in the last year, most of that is traceable to the behavior of really only a few thousand people, maybe 10,000, maybe 12,000. It's not a lot of people. They're all embedded in corporate entities. Can you imagine assigning personal responsibility to these people, or will they always be protected by the corporate shield? And if you can imagine assigning personal responsibility, what are some of the harshest sanctions that you can imagine for this kind of behavior? How harsh does it get? Or how lenient must it be?
Oh man, is there a better question than that? That is so hard to answer. While you were asking that question, I was thinking of some really good writing that was done. If you don't mind if I mention another magazine, Vanity Fair, in which there's some awfully good writers and some good investigative work done as well. There was a good piece done about an investment bank in that magazine, and I was reading about some people inside an investment bank, and you read about what they did, in order to make their $20 million a year for each of them, and you think to yourself, somebody needs to go track this down and put them on, make them accountable, hold them accountable for what they have done. Not just those two people they were describing, but others as well. That's why I think that and maybe we still could get. I tried very hard at the start of this year and failed. Get a select committee of the Congress with subpoena power that does what Pecora did as an investigator of the banking committee in the 1930s. I mean, he called people up here and had hearing after hearing after hearing after hearing, and wouldn't let them off the hook. And as a result, we have a narrative of what happened. We don't have that narrative at this point. I mean, we kind of know. I talked to you this morning about some of it, but you're right. I mean, there are people who. One person left, I've described the company here, with $200 million. $200 million after we had this unbelievable pollution of our financial system. And, who knows what that person is doing at the moment. But there ought to be accountability. And you're right, I don't know how many people it is, but there's a lot of people. And by the way, I assume some of them are still with those firms and some perhaps in government. But in any event, we ought to be vigilant in finding out how this happened and who allowed it to happen beyond what we already know, because there's much more to learn. This is not some natural disaster. I understand hurricanes and earthquakes and so on, but this is not some natural disaster. This collapse, in my judgment, was a result of unbelievable ignorance and greed. Go ahead. Pardon me?
That's natural.
Well, okay. Natural, but you know what? I never want to accept it as natural. To me, it's unnatural to have allowed this to happen.
I'm Susie Kim from the New Republic. I had two questions for you. The first was with regard to your comments about the fact that it feels like nothing has changed on Wall Street. I was wondering, in terms of the American public and how they're going to view the government's attempt to, for financial regulation, the fact that the stock market is recovering. We have this celebration of the Dow hitting 10,000 again, while unemployment is still, at record highs. How are they going to feel about more government intervention when it seems like the people who are benefiting are, once again, these corporations, and with regard to stock values, whereas the elements of recovery have yet to kick in for the vast majority of the American public. What do you anticipate? How are the Democrats going to sell this to the American public? How are they going to feel? And the second question was just quickly with regard to the banking lobby and how they're going to oppose, many elements of the regulatory reform. Yeah. Are there certain things that you feel like will sort of enhance their power in the upcoming months, perhaps with regard to midterm elections, campaign finance and sort of fundraising and so forth? And what are your concerns about how to curtail that lobby?
Well, the fact is Wall Street has a lot to protect, and they'll protect it with all the effort and muscle that they have. You talk about the stock market. I think that 10,000 Dow is far ahead of the economy, which worries me a bit. I'm not very interested in seeing bubbles in our future, and I guess would I prefer that the stock market show increased value rather than decreased value? Yes, but I'd be much more comfortable if the stock market were more readily tracking what I think is really happening in the economy. I think we have bottomed out from all that I can tell and are going to begin to rebuild. I think new employment is going to be slower than we would like. But the stock market, when you see 140-point days, it makes me a little nervous because I'm wondering what are the set of facts on which that is based. The most important facts to me about the long-term growth of this economy is not how much money an investment bank made. A $3.2 billion quarter profit reported by an investment bank is much less relevant to me than the question of how many people are we putting back to work. How many people in this country are we going to put back to work that have the consumption capability to help drive the economy? I mean, a good job that pays well is more important than any social program that I'm aware of, and so I worry very much about the fact that we are still losing jobs, not gaining jobs, and yet the stock markets, hit 10,000 yesterday. I just think the stock market is not well connected to the rest of the economy at the moment. I have to be on Capitol Hill for something about 9:15, so I'm going to have to go. One more question?
Hi, Laura Eom. I'm a freelance reporter for Deutsche Welle Radio. And I was just curious in terms of what you see sort of as the legislation, more specifically about what you can do in terms of perhaps criminal penalties, or is it just enough to create a position within the government that will oversee the financial system, and then therefore from that person will then issue those regulations, perhaps talk about criminal penalties, because apparently a lot of what happened actually was legal. So what rules are you going to put in place?
Well, we have a criminal justice system for to prosecute a crime. You're correct that perhaps a fair amount of what happened was legal. The creation of unbelievably complicated financial instruments, the trading of which made a lot of money for some very big interests, and it turns out that it wasn't productive enterprise, and we had people end up with a lot of bad paper. Companies end up with a lot of bad paper. Then the country created something called TARP, which, as I said, was a bait and switch operation. And so, I guess the answer is Bernie Madoff is in prison, right? That's good, but he swindled people out of $50+ billion, and the SEC was told he was swindling people and did nothing about it. So, what about the folks in the SEC that did nothing about it? What about their accountability? And there are so many others. Bernie Madoff is just the symbol here. I mean, in my judgment, there's a fair amount of activity that ought to be investigated, and people ought to be held accountable for it. On the other hand, I think much of what has been the most troublesome are people who were paid a monthly salary by the federal government, who were hired to regulate, who willfully boasted that they wanted to be blind because they didn't believe in regulation. Put in charge of agencies that, for example, should have and would have, under normal circumstances, made sure there was transparency for the trading of certain kinds of products, and who said, you know what, we're going to put out no action letters so that we can push those products over into the dark so we don't have to look at them. That, it seems to me, represents a whole body of interests that need to be held accountable. There's just so much that we need to do and still know, even as we put this financial reform back together somehow, or create financial reform that protects us from this kind of a problem in the future. This is a great country. Let me tell you one final point. This is a great country with great strength and resilience, and we're going to come back from this. I asked Warren Buffett to come to meet with our caucus. I've done it 3 or 4 times, and about 3 months ago he came, and we spent an hour, over about 50 senators spent an hour talking to Warren, and somebody asked him the question, what is going to happen? What do you see for the next 6 months for our economy? And Warren Buffett says, I don't have the foggiest idea. It's not the way I think. I don't know what's going to happen 6 months from now or 16 months from now, but he says, I'll tell you what I do know, that 6 years from now, this country will be in great shape, creating jobs, expanding. Why? Because for 2 centuries, it's sort of the nature of the American people to build and create and push. And this has been a very big setback. But he said, I'm convinced, I'm full of optimism that we'll put ourselves back on track, do the things we need to do to make sure this doesn't happen again, and move on to productive enterprise. That's just the nature of the American people. I do have that reservoir of belief. I think if you didn't, you'd have trouble working on these problems. But I really believe that this country has a great future, but it's going to require us, a lot of us, to do the right thing to make sure that those that were involved in helping steer this country into the ditch cannot ever do it again.
Please join me in thanking Sir.
Thank you very much. Enjoyed being here.